Hey, and welcome back to the deep dive. You know that feeling right now, that sort of persistent hum of uncertainty about the economy?
Hmm.
It's like everyone's asking, okay, but what's really going on? Where are things, headed?
Absolutely, it's palpable.
Well, we've rolled up our sleeves and dove into a stack of sources that just dropped the latest OECD Economic Outlook report from June 2025.
Right, the big one.
And our mission today is, well, pretty clear. Cut through all the complexity, the charts, the jargon,
Yeah.
and pull out the most important nuggets of knowledge just for you. We want to understand the core challenges the report sees, especially this theme of tackling uncertainty, reviving growth,
Mm.
and get a real handle on what the experts at the OECD are actually seeing right now. So we'll look at their global forecast, understand these forces driving uncertainty.
Trade stuff, policy.
Exactly. Look at how policy is responding and, crucially, what pathways they suggest for getting back to, stronger growth and investment.
And what's really interesting here, I think, is how this report tries to connect the dots. It's not just numbers in isolation.
Right.
It's about the interplay,
Yeah.
how these forces create uncertainty, and how that links right back to the policy decisions everyone's grappling with. It's seeing the system.
Okay, let's unpack this then. Start with that big picture, the global economy. The headline seems to be, well, slowing growth.
That's the core message, yeah. The projection is for a pretty significant weakening.
How significant are we talking?
Well, they look at a Q4 over Q4, comparing the end of one year to the end of the next. And on that basis, global growth is expected to slow quite sharply, down to just 2.6% by the end of 2025,
Wow. Okay, and that's down
from 3.4% in 2024.
Yeah.
So, yeah, a notable drop. The report really flags this slowdown.
And what's behind that slip? What are the main drivers?
It's really linked to all the themes we're going to dig into. Increasing trade barriers are a big one.
We'll definitely get to that.
Yeah. Plus this elevated policy uncertainty that's making businesses hesitate. And, the lingering effects of higher interest rates finally biting.
Right, the tightening we saw. Okay, so growth slowing. What about inflation? That's been the big story for ages, hasn't it? Is it finally getting under control according to this?
Well, the report does see inflation moving closer to central bank targets.
Yeah.
So, progress.
But there's always a but.
The nuance, yeah, is that it's now expected to take longer than they previously thought to actually hit those targets in most places.
So the last mile problem is real.
It seems so. And the risk of inflation being stickier, more persistent than forecast,
Right.
that's definitely still there. And that could force policymakers to, rethink things.
And labor markets play into this inflation picture too, right? Are they still super tight?
They're improving, cooling off from their peak tightness,
Yeah.
but still pretty firm overall. Wage growth has eased, which helps with inflation. But it's still running higher than before the pandemic in a lot of economies. The report mentions the U.S. specifically. Unemployment there is projected to rise a bit, maybe towards 4.5% by early 2026, as growth slows.
Before settling down again.
If they're moderating, yeah.
Yeah.
That rebalancing in the jobs market is seen as pretty crucial for getting inflation down sustainably.
Okay, now here's where it gets really interesting, I think. That tackling uncertainty theme. The report points to a major driver, this surge in trade barriers. And they specifically mention new U.S. tariffs.
They do. And
Oh.
the numbers are pretty stark. They estimate these new U.S. tariffs, the ones brought in up to mid-May this year,
Right.
have pushed up the ex-ante effective tariff rate. That's like the average tariff before you account for any, complex workarounds.
Gotcha.
On U.S. merchandise imports to 15.4%.
Wait, 15.4%. What was it just a few months ago?
Get this. It was just over 2% back in January 2025.
That's a massive jump.
Um,
Incredibly fast.
It is. And adding to the uncertainty, the report notes there's even the possibility of more tariffs coming in from July 2025.
Wow. Okay, so a leap from 2% to over 15%, practically overnight. What does the OECD say this actually does to the global economy? What are the real impacts?
Well, several big ripple effects. First, obviously, it directly weighs on global growth. Trade just gets more expensive, less efficient.
Makes sense.
Second, and maybe a bit counterintuitive, it tends to fuel inflation in the U.S., the place imposing the tariffs. Global demand might soften, but the cost of imports goes up, pushing up prices domestically.
Right.
And third, it really shakes up financial markets.
Okay, how specifically? Does the report give examples?
Yeah, it does. Stock prices of companies really exposed to these U.S. tariffs They've underperformed the wider market.
Okay.
Capital flows, money moving across borders, have become super sensitive to swings in the dollar exchange rate, and borrowing costs have gone up, especially for lower income or riskier countries. Investors just demand a higher return when things feel this uncertain. The risk premium rises.
And it's not just a general global effect, is it? Some countries feel this much more directly.
Exactly. The report names names, basically.
Uh-huh.
Countries with high direct export exposure to the U.S. market.
Like who?
Mexico, Canada, Ireland, Korea, Chile, Colombia, Costa Rica. They're listed as having relatively high direct exposure.
Okay.
But the ripples spread out. It affects trade flows everywhere, contributes to weak trade growth overall. They mention it weighing specifically on Europe, too.
So trade barriers are a huge piece of this uncertainty puzzle. But the report says it's not just trade, right? Policy uncertainty is broader.
Absolutely. Beyond trade, they point to increased uncertainty since early 2024 across other key areas. Fiscal policy,
Taxes and spending.
regulatory policy, climate policies. When the rules of the game seem unclear or likely to change, it just creates hesitation.
And how does that kind of government uncertainty connect to, say, how you or I feel as consumers or how businesses feel, confidence levels?
There's a pretty direct link drawn in the report. They connect this wider policy uncertainty straight to falling confidence.
Oh, really?
Yeah, they mention a sharp drop in U.S. consumer confidence since December 2024, and their analysis links it significantly to this rise in policy uncertainty.
Interesting.
And business surveys, too, in places like Canada, Mexico, Spain, the U.S. They've also shown confidence slowing down since early 2025. If you're a business and you're unsure about future taxes or regulations or climate rules,
You hold back on big plans.
exactly, you're less likely to make those big long-term spending or investment commitments.
Which brings us right to investment. A really critical point the report makes is that uncertainty has become a much bigger obstacle there.
It really has. The report explains that uncertainty basically widens the gap between the cost of financing, like your loan rate,
Right.
and the hurdle rate businesses demand. That's the minimum return a project needs to promise before they'll take the risk.
So if the future looks foggy, you need a bigger potential payoff to jump in.
Precisely. The risk premium goes up internally, too.
And the report talks about this investment puzzle, right? That investment levels just seem stuck, lower than they should be.
Yeah, this is a major theme. Aggregate real investment across advanced economies, still way below the trend line from before the global financial crisis.
How far below?
About 22% below at the end of 2024. Even compared to the pre-COVID trend, it's still lagging, about 7% lower.
And it's not just because borrowing is expensive.
Well, that's part of it, but the report says that doesn't fully explain the weakness. Even strong corporate profits aren't solving it.
That seems weird. Lots of profits, but firms aren't reinvesting it.
That's the puzzle. Strong profitability hasn't translated into correspondingly higher gross fixed capital investment. Building factories, buying machines.
So where's the money going?
Instead, firms seem to have favored piling up financial assets or just giving money back to shareholders, dividends, stock buyback.
Okay, so if it's not just borrowing costs or lack of profits, what else is holding investment back? Structural stuff.
The report points to a few things. One is this ongoing shift towards digital and knowledge-based assets, intangibles.
Like software, R&D.
Exactly. They might be financed differently, maybe harder to measure in traditional investment stats.
Okay.
Then there's rising market concentration, bigger firms dominating industries, and a related decline in business dynamism. Fewer startups, less churn.
And how does that connect to weak investment?
Well, the thinking is, if you're a dominant firm in a less competitive market, maybe you feel less pressure to invest aggressively in new stuff or expansion, less incentive.
Right. Complacency can set in. Okay, so this is a complex picture. Slowing growth, sticky inflation, major uncertainty hitting investment. How are governments and central banks actually responding? Let's talk policy.
Okay. On the monetary side, central banks, the general stance is still restrictive, keeping rates relatively high to fight inflation.
Still leaning against price pressures?
Pretty much.
Okay.
Although, interestingly, short-term real rates, that's after you account for short-run inflation expectations, they actually dipped a bit in places like the U.S.
Why is that?
Because those near-term inflation expectations ticked up slightly.
Ah, okay. So what's the projection? Are rate cuts finally coming?
The forecast suggests yes. For most advanced economies, rate cuts will likely continue. Japan's the main exception.
Okay.
And some emerging markets, too. India, Indonesia, Turkey are mentioned. The general idea is rates moving back towards more neutral levels by the end of 2026.
But it varies a lot by country.
Oh, yeah. Brazil, for instance, is actually projected to hike rates first before cutting later. And the report stresses central banks need to stay vigilant if inflation proves more stubborn.
They might have to hold off or even reverse course?
Exactly. Flexibility is key, but the inflation fight isn't totally over.
Okay, now what about the other side? Fiscal policy. Governments. The report flags high debt as a big challenge.
Huge challenge. Many OECD countries have high debt burdens, and on top of that, they face massive, growing spending pressures.
Like what?
Well, population aging is a big one, needing more health care, pensions.
The demographics.
Right. Then there's climate change, adapting to it, investing in the green transition that costs serious money.
Trillions, globally.
And, increasingly, defense spending is on the rise, particularly in Central and Eastern Europe post-Ukraine. Some countries are aiming for 2% of GDP or even more.
And the U.S. deficit.
The report specifically flags the large structural deficit in the U.S., the gap that exists, even when the economy is doing okay, projected over 8% of GDP overall.
Wow. That's a lot of pressure on government budgets already stretched thin.
It is, which is why the report really emphasizes the need for credible, medium-term fiscal plans.
Plans to show how they'll get debt under control.
Exactly. How they'll manage the debt path, build some buffers for the next crisis, and, crucially, how they'll make the really difficult choices about prioritizing between all these competing demands, aging, climate, defense.
Okay, so faced with all this slowing growth, uncertainty, the investment puzzle, this fiscal squeeze, does the report offer any way out? Any pathways to actually revive growth?
It absolutely does. And the foundation, according to the report, is tackling that uncertainty head on.
Reduce the policy fog.
Precisely. Just easing those trade tensions we talked about would be a huge help. That's seen as key to getting investment going again.
Okay, so less uncertainty is step one. What about specific structural reforms? Things governments can actively do.
They point to several areas. On trade, beyond just lowering tariffs, it's about improving trade facilitation, making the logistics smoother, cheaper.
Cutting red tape at borders.
Things like that.
Yeah.
And reforming regulations in the services sector, which is a huge part of modern trade. They mention using tools like the Services Trade Restrictiveness Index to identify where barriers are highest.
Right, and for tackling that weak investment.
Promoting business dynamism is key. Making it easier for new companies to start up, strengthening competition policy. The idea being more competition spurs more investment.
Makes sense.
And also addressing other structural barriers, like restrictive land use rules or rental market regulations that can hold back much-needed housing investment.
And what about driving the right kind of investment, the productive stuff like green tech, digital infrastructure?
Yeah, the report stresses high-quality public investment here. Governments putting money into green and digital infrastructure, R&D, education, health.
Laying the groundwork.
Exactly. But also policies to actively encourage private investment in these areas.
Oh.
Things like targeted tax incentives, capital allowances, letting firms write off investments faster, improving capital markets so they're better at funding intangible assets, maybe with some public support, and reducing barriers to foreign direct investment.
So when we connect this back to you, the listener, these aren't just abstract ideas, are they? Smarter regulation, better public investment, policies encouraging private firms to build and innovate, more predictable government action.
Right.
How could that affect your job, the innovation you see, maybe even the cost of things you buy? It all ties back to trying to build a more dynamic, resilient, and hopefully faster-growing economy for everyone.
Precisely. The report is laying out the potential toolkit for policymakers to try and shift things away from this low-growth, high-uncertainty rut.
Okay, nearly there. Reports like this always look at risks too, right? What could go wrong, but also maybe what could go unexpectedly right.
Yeah, they cover both. On the downside, risks like trade tensions escalating even further, inflation staying stubbornly high, forcing even tighter monetary policy,
Ouch.
and potential financial stability wobbles, maybe from those concentrated markets we talked about or, areas like crypto assets.
Always a wild card. But is there any hope for things turning out better than the baseline? Upside surprises.
Yes, they balance it. A significant reversal of those trade restrictions would obviously be a major plus.
De-escalation.
Right. More ambitious, effective structural reforms than expected could unlock growth. And, maybe faster than expected technological progress, perhaps spurred by AI, could boost productivity.
Okay, that was definitely a deep dive into the OECD's June 2025 Economic Outlook. Let's try and quickly wrap up the key takeaways. The big picture seems to be a global economy grappling with slowing growth, inflation sticking around longer than hoped,
Persist.
and really significant uncertainty, driven mainly by those rising trade tensions and just broader unpredictability in policy, fiscal, regulatory climate.
Yeah.
And all that uncertainty, the OECD says, is really hitting business investment hard, contributing to this ongoing investment puzzle.
And the report's message on navigating this is about a careful policy mix. Central banks need to be vigilant on inflation, but stay flexible.
Right.
Governments are facing huge spending demands, aging, climate, defense.
Yeah.
So credible medium-term fiscal plans are vital to manage the high debt.
Gotta have a plan.
And, crucially, those targeted structural reforms are needed to reduce uncertainty, boost competition, and really incentivize investment in the key areas green, digital, people.
That definitely gives us a much clearer sense of what the experts are seeing and recommending. Thanks for joining us on this deep dive.
My pleasure. Good to talk it through.
So, here's a final thought for you, the listener, to chew on. It stems right from this report, especially those huge spending pressures. Think about it. You've got increasing defense spending, seemingly locked in globally, and you've got the massive urgent need for climate action and investment for aging societies. How on earth do countries realistically balance those enormous competing demands on their budgets?
Especially when debt is already high.
Exactly. How do they manage that balancing act while also trying to keep debt sustainable? What does that struggle mean for the kind of economic future you'll actually be living in? Something to think about. We'll see you next time on The Deep Dive.